If you're retiring in Ohio, or maybe you're helping a parent with their finances, you need to know something. There is a specific combination of credits on the state tax return that is without a doubt one of the most significant and commonly missed opportunities in the entire tax code. So today, we are running a full forensic audit on this. Okay, let's get into it.
So what's this number all about? We're talking about $1,150 in pure tax reduction, money that is just being left on the table by Ohio seniors every single year. And look, this isn't some shady loophole, it's the direct result of not understanding how two very specific, very powerful credits were actually designed to work together.
We call this strategy the Ohio double dip. And let me be perfectly clear, this is 100% legal. It's an intended mechanism right there in the Ohio Revised Code. All it is the simple act of stacking the senior citizen credit on top of the retirement income credit. You know, a lot of people, and frankly even some tax software, they just assume you can only take one. Well, that's just plain false.
But here's the really critical finding from our audit. That unclaimed money, as big a deal as it is, it might actually be the lesser of two evils. You see, there's a trap built right into the Ohio tax form. It looks tempting, but it can lead to a permanent, costly mistake that you can never, ever take back.
We call this the poison pill. It's this option to take a one-time lump sum distribution credit. And yeah, it looks like a windfall, right? Like getting several years' worth of credits all at once. But checking this box, well, that triggers an irreversible choice, and it has some really serious long-term consequences for your financial future. Let's just run the math. It's pretty stark. The annual double dip strategy could put $5,000 or even more back in your pocket over a 20-year retirement. That poison pill, the lump sum, it might give you a one-time credit of, say, $1,200 today. Taking that lump sum is literally like borrowing from your future self at a terrible, terrible exchange rate.
And hey, don't just take my word for it. This is a direct warning from the Ohio Department of Taxation itself. It says right there, once you make this selection, it is permanent. You are disqualified from claiming these valuable credits for the rest of your life. That is the poison pill in action.
So how do we avoid the trap and actually execute this strategy the right way? Let's get into the audit and see how this whole thing is built. We're going to break down the double dip into its two main parts.
All right, step one is the foundation, the senior citizen credit. You'll find this on line 4 of the schedule of credits. If you're 65 or older and your modified adjusted gross income, your MAGI, is under $100,000, you are entitled to a $50 credit. It's simple, it's straightforward, it's your starting point. Now for step 2. This is where the dip actually happens. On line 2, you stack the retirement income credit right on top. Now this isn't a flat amount, it's on a sliding scale. As you can see here, once your qualifying retirement income for the year goes over $8,000, you max out the credit at a really nice $200. So you put them together, that's $250 per person right off your tax bill.
But, and this is a big but, here's a critical catch that trips up so many retirees. Because Ohio doesn't tax your Social Security benefits, they don't count as qualifying income to get this credit. So if you live only on Social Security, your credit here is zero. This might mean you need to make a strategic withdrawal from a traditional IRA just over $8,000 just to trigger the full $200 credit.
Now for married couples, the strategy gets even better. We can actually evolve the double dip into what we call the triple stack. And this means adding a third very powerful credit that can unlock an extra $650.
This is the joint filing credit, but it has a very strict trigger. To get it, both you and your spouse must each have at least $500 of what the state calls qualifying income. And trust me, the definition of that term is incredibly important. And here's where it gets interesting. Pensions, 401k withdrawals, wages, those all count. But notice what doesn't. Interest, dividends, capital gains, basically all your typical investment income is out. So if one spouse only has that kind of income, you lose the entire $650 credit. A tiny $500 IRA withdrawal for that spouse could unlock the whole thing.
So let's just put it all together. You've got $250 for the first spouse from their double dip, you've got another $250 for the second spouse, and because they both met that tiny income trigger, you get to add the maximum $650 joint filing credit. The grand total, a potential tax reduction of $1,150.
Okay, so now you know exactly how to claim these credits, but we have to talk about how to protect them, because there's one major threat that can just wipe out the entire stack, and it doesn't matter what your age is or where your income comes from.
The number you have to burn into your brain is $100,000. This is the strict income limit for both the senior citizen and the retirement income credits. And what's so crucial here is that it's based on your modified adjusted gross income, or MAGI, which is often higher than your regular old taxable income.
And this is not some gradual phase out. It is a hard cliff. I mean, look at this. If your MAGI is $99,999, you get the full boat. But if a small capital gain or an IRA withdrawal pushes you over the line to $100,001, just $2 more, the entire credit stack vanishes. Poof, it drops to zero.
So here's your forensic checklist for this tax season. It's simple. First, verify that you are stacking the credits on line 4 and line 2. Second, avoid that poison pill lump sum election at all costs. Third, if you're married, make sure both you and your spouse have at least $500 of qualifying income. And finally, you have to actively monitor that $100,000 MAGI Cliff before the end of the year. And that really just leaves us with one final critical question. You know, a tax return is just an annual event, but your retirement, that's a 20, maybe 30-year journey. So you really have to ask yourself, is your tax strategy, whether it comes from software or from an advisor, is it optimizing for the biggest possible refund this April, or is it protecting the maximum possible value for your entire retirement legacy?